Thank you very much for that, Lynn. Robert Schein is the CIO of Blanke Schein Wealth Management, joining us with his take on things. Robert, what did you make of the China data yesterday? And after, I don't know how many times have analysts said that there's a turnaround in the works, do you think this time is it?
Well, we're going to see it play out real time, just like in China and the US. Everyone is data dependent, and that's sort of that suspended animation that we're in right now, where that data is coming in mixed, and it's kind of a touch and go situation for central banks around the world, as well as here in the United States.
Indeed, and what we are seeing right now, obviously, is the intervention from the central bank in China, the PBOC, into the currency market on expectation that that the Fed may not cut rates, and that those rate cut expectations may get abated a bit. Do you think that is the way forward?
Yeah, clearly we're going to see who basically has to accommodate first. And in what manner do they do it? Do they do it through currency? Do they do it through easing of financial, let's say, pressures? Even Lagarde was here earlier this morning saying that she still needs more data to basically, move forward with regards to their interest rate policy. But keep in mind, they're the ones the first to move in September. And then October, the Federal Reserve then followed suit. And that's when we've seen this tremendous rally in assets across the U.S. and around the world since October as a result. So now we're on the other side of that, and now it's sort of this tightrope of, wait a minute, a lot of it's been baked into the market, so we have to be very cautious moving forward, both here as well as globally speaking.
Robert, can I ask you, the first time around when we continue to see this pervasive inflation, pretty much every company was able to exercise a whole lot of pricing power. It started to unwind, but then we started to get, data that was suggesting that we were on the contraction path. But if we see a second wave, should we be positioning or having the expectation that the same ones that had that pricing power still have it? Because the situation's a little bit different in terms of people's tolerances to these increases.
Absolutely. In fact, you might know this as well as I do, that 87% of the time inflation comes in two waves. And we're on the back slope of the first wave. So we could repeat a 1970 policy error. And one of the concerns and the catalyst would be the oil markets and the heating up of the global tensions this summer. So we're not out of the woods by any stretch of the imagination. I think the Federal Reserve has got a lot of work to do in terms of communication, because again, the markets are literally pricing in sort of Goldilocks. And we said this on your well before when we were with you months ago, even end of last year. We believe, and we're in the camp of higher for longer. So what that translates into, you can't just buy the market, you can't just buy the indices and set it and forget it. You can still find great opportunities within this market. You just have to do your homework and go for some high quality companies that can have that pricing power, supply chain management, and get through sort of the tough times ahead, potentially.
How significant would the second wave be?
Pardon?
How significant would the second wave of inflation be? You're saying we're on the back slope of the first wave. Yeah. How significant could the second wave be? And if you're saying oil is going to be a worry, then that issue doesn't get solved by rates. So do we see rates staying at 5.5%, or moving higher?
Well, the 10-year Treasury is on an upward trajectory, right? We broke out last week based upon the inflation data that came out of the United States. We believe it could test the 5% level before sort of summer's end, if you will. You add in obviously some oil pressures could see 100 as a result of a multitude of issues that are playing out. And at the end of the day, you've got to find those companies that could sort through all of the inflationary pressures. The second wave of inflation could take some time, and it does usually take basically a few years to play out. But it sometimes, more often than not, is even larger than the first wave, and that's the concern. Let's think of it this way. It's really easy just to conceptualize. Everyone here in the United States is holding their breath, waiting for interest rates to come down to buy, in this housing market. Well, guess what? As soon as rates come down, that demand's going to double, and then housing prices are going to re-accelerate. Rents are going to re-accelerate. That's going to be a challenge for the Federal Reserve and everyone's going to be chasing the real estate market once again, but they're all holding up. That's penting up demand here in the United States based upon just like one little sector of the economy, which is a large sector, the sort of the housing market. And housing, there's a big supply demand sort of shortage there. And that's how we know when interest rates fall back, we could see, buyers come in, and then that's just one area that we could see, again, a reacceleration of inflation and those pricing pressures.
And all the inputs that go into housing. But just really quickly, because we're going to talk about some of your stocks after the break, keeping the audience on the hook, of course. But just in terms of your duration expectations then, because you were suggesting we could blip up to 5, and then from what I could take from what you were saying, it's that you're basically alluding that we are going to see a pull-in on yields. So are you trying to now, up your allocation to the longer end of the curve in expectation that you might, take a little bit of a hit on the way up to 5, but it's going to pull in quite considerably after that?
Yeah, so particularly for our book of business and what we've done for our clients is we've been rolling and laddering treasuries, within the 2-year mark. And so now we've got a lot of treasuries even coming due. And as they come due, we're re-upping, again, a little bit out maybe the yield curve from this point forward. We're going to wait and see how the treasury market reacts. We even held off. We've had, a substantial amount of treasuries mature right before the CPI. We held off by reinvesting. So we weren't automatic as we did that. We were very surgical and very thoughtful. And we got a bump in rates. So as we have maturities coming due, we're going to watch this market and the data that's coming out. We're going to play into it. And as soon as we get to sort of a level that we believe we could see, markets or yields right where we like them, we're going to push the duration. We're slowly doing that and sort of a laddered effect on our portfolio. But again, no one really knows. No one can top the market. No one can tell what the timing is. But if you use a laddered sort of rolling effect of like we are, that strategy has been very successful.
Of course. So we're going to got a lot more to talk about when we return from the bank. So bank. Stay right there. Street Signs is going to be back with Robert Schein from Blanke Schein in just a few seconds. You're back on the street, and we're back with Robert Schein from Blanke Schein Wealth Management. And, we did the setup, so let's talk about the stocks now. I've got to ask you first about a company that has been doing incredibly well of late. And I really want to know the rationalization as to what the next leg of upside can be, and that's Amazon that we're talking about. I know I probably did a little bit of a misdirect there. You probably thought I was talking about Eli Lilly. But in terms of what comes next for them, you don't think that they're, under pressure from the Temus and the Scheins of the world, or do they just live in their own little moat with AWS and everything else?
It's a great question. And Amazon is if you look at year over year, have done exceptionally well for our clients. Our clients are extremely happy, even year to date, if you look at the performance. If you go back even before that, though, a few years back, Amazon didn't perform so well. And it was a multi-year turnaround story that kicked in based upon a lot of great management and a lot of disciplined choices that they made in 2023 that really turned the story around. It's not just the retail e-commerce giant that they are. As you're pointing out, it's also the AWS and the cloud sort of growth. There's a turnaround story there. It's growing tremendously, better than expected, and it's finally ramping up. So Amazon's that giant that has the scale, but also has the, operational efficiency and excellence to make the right moves, even though where they're unpopular, because they can see 3-4 quarters ahead or even 2 or 3 years down the road. So we believe there's a lot more room to run based upon the decisions they made a few years back. And that's what we're seeing the success play out today.
Just one more on Amazon, and I suppose it's more about their video offerings. They've got a new show, Fallout. I absolutely love it. But sport is something that you mentioned. Do you foresee them getting incredibly aggressive? Because we've got the NBA rights deals coming up. There's always NFL packages that are up on offer. Just look at what our parent company did and just bought one playoff game in terms of the NFL. Do you think that is where they're really going to target? And obviously that comes with a pretty hefty cost as well.
I think the evidence is absolutely empirical out there right now, whether it relates to, if you look at the top 10 shows last year, in just television tuning in, they were all from the Super Bowl all the way down. It was all the NFL. Traditional television is sports. And so the way they monetize that moving forward, the Amazons of the world, the Googles, obviously Netflix is stepping into that realm. That really is the formula moving forward for traditional television, because right now there's nobody else that can compete with them. So yeah, Amazon will see some growth. I'm excited to see how they capitalize on it. And they start with Thursday nights, but they'll continue to expand their offering. And I think they'll be quite successful in doing so.
Right. You also like the Invesco Aerospace and Defense ETF. Robert, how much of that is really maybe a Trump trade if he were to return, given his how typically he, of course, has seen reason for more defense spending?
We don't look at it politically as a Trump trade very specifically. We look at like what happened this last weekend, right? The tensions that are happening geopolitically. Now we have, the tensions with Iran in the Middle East. You also have Ukraine. We've had this trade, if you will, this in our client portfolios for quite some time. And the reason why is everyone needs a little defense in their portfolios, right? And this is an industrial way of handling sort of the top 10 industrial and aerospace companies, and by way of this ETF. So we've owned this for a while. It's underperformed last year, but now year to date, it's really, taking off for all the obvious reasons. Keep in mind, we also like to position where the money's going to be. So we believe that Congress is going to pass another Defense Spending Act. Money's going to fall by way of anywhere from the B-2 bomber to the F-35, or even what we saw most recently, the Tamir missiles and radar defense technology by Raytheon. So you got to follow the money. And it's not just the United States defense spending in addition to our defense budget annually. It's also NATO countries as well that are going to have to improve sort of this sector. And so we want to position ourselves where the money's going to be. And on a multi-year, multi-decade basis, defense is the place to be.
So why the ETF and why not specific names, Robert?
We do own individual names, and if we want additional exposure, again, like Raytheon, Northrop Grumman, and there's also additional names in there that are very attractive. But for the average investor, if you will, for the investor that doesn't have, most investors don't even have exposure to industrials as they should. And most just think industrials as Boeing. And so, beyond Boeing, that's inside this ETF, and that's down 35% year to date, just that one Boeing holding. The ETF itself is a diversified approach to not just put all your chips on one particular defense name or aerospace name.
Okay, Robert, we'll leave it at that. Thank you very much for joining us and giving us your perspective on the markets. Appreciate it.